Hello traders, welcome back to a new video here on the channel. So today I released a video recently talking about how you can use the TradingView platform in order to do different market comparisons where you can see if there's any positive and negative correlations in the markets. And in this video, we're actually going to go into some examples of different market relationships and how these ones can be useful for you in your own trading decisions. As always, make sure to subscribe to the channel, hit notifications on so you don't miss out on any new content coming out multiple days a week. And you can also follow on Twitter, as well as check out all the links in the video description of my most popular videos on order flow, volume profile, and price action. And you can learn all my trading strategies, swing trade and day trade, in my course page that is linked down below as well. So first, let's talk in general. What are market correlations? So a correlation is a statistical measure that determines how assets move in relation to one another. You can use this in a variety of different markets like stocks, Forex, index futures, etc. In general, correlations are measured from -1 to +1. So if there's two markets that, let's say, move exactly the same one against the other, we would say that it has a +1 correlation. And inversely, if we have two markets that move completely opposite to one another, then it would be a -1. And you can make a internet search just for market correlations, and there's a ton of information and a lot of different tables with different correlation relationships between various instruments. In general, why are correlations good to know? Well, because it can help us to gain perspective as far as the overall nature of the larger market. Now, this is something I think is especially useful for more swing trading or longer term trading. But even if you're day trading, you can take advantage of this discrepancies. And also, by knowing what markets are correlated and how, you can also practice better risk management in your trading, because you're not going to be overexposing yourself to markets that might move the same way together. Or similarly, a lot, for example, hedge funds do what they call hedging, which is they take positions that are inversely correlated. So maybe one market is going to go up, the other one is going to go down, but they may use it in different strategies to protect capital or to try to gain from the different spreads or the arbitrage in the markets, etc. Okay, so let's start off with the examples. Again, this is the TradingView platform. I have 2 markets per page, but you can even add on more markets. You can compare several markets at once. Generally, I like to just use 2. We're going to be looking at daily charts, and I have the scale for the main market that you're going to see on top on the right side, and then the scale for the secondary market, which is this hollow candles below, are going to be the scale on the left. And again, I have a video here explaining how you can use all these functions on TradingView, how to set this up, etc. So go check that out on my channel. So first example, here we have the futures market on the CME. We have the S&P 500 on top, and we have the NASDAQ or the NQ on the bottom. As you can see, these are 2 very highly correlated markets where you can see in periods where the S&P is on a downtrend, the NASDAQ is usually behaving the same. Now, they're not exactly like one another. Like you can see, for example, here, we had these 2 highs that we broke above. Whereas on the NASDAQ, you can see we have like a double top here, and here we have a little deviation. So there's a few slight differences as we can expect. NQ is obviously more geared toward tech stocks, is the top 100 of the S&P, and the S&P is top 100 of the stock market in total, and the S&P is the top 500. So there's going to be some differences in them, but overall we'll say these are two highly correlated markets. So let's say if you're going to put a swing trade long on the S&P, and you have a rule that you're going to put just a 2% risk per trade based on your total account size. Well, if you put, let's say you get long right here on the S&P, and you get long at exactly the same place on the NASDAQ, since these two markets move pretty much the same, you're actually going to be risking about 4%, because these two markets, whether they go up or down, they're going to do it in tandem. So you just got to watch your risk on trades on highly correlated markets, because you could be risking more than what you think you are risking in total. So let's go to the next example. Here's another example of two highly correlated markets. This is in the Forex market, and again, this is a daily chart as well. You can do this on any time frame, it'll be the same. But here we have on the top Euro US dollar, and on the bottom we have GBP US dollar, pound dollar. So as you can see, since both of these markets have the two main European coins against the dollar base, you can see that this move again very similarly. When GDP is going down, the Euro US dollar is going down as well. Here we have this big low before we start rotating up, right at the same place that the GBP is turning as well. So same thing, Euro dollar and pound dollar are two highly correlated markets. Same thing if we go into the Australian dollar and the New Zealand dollar. These are two markets that again are very positively correlated, and they move very similar. Now let's look at some examples of inverse. So right here on top we have the US dollar index, symbol is DXY. If you're trading Forex, this is a very important instrument to track, as this measures pretty much the overall strength of the US dollar. So if we have dollar index on top and we have Euro US dollar on the bottom, you can see how these markets are inverse. They're negatively correlated. And why is that? Well, because when we're comparing euro to dollar, that means that if the euro is doing well and is going up, that means it's because the dollar itself is looking weak. DXY is basically the dollar index market, so then that means this is going to be going down as well. So you can see right here how in November 2022 we had a big high on the dollar index and we had a big low on the euro dollar. So here dollar index goes up, euro goes down, dollar index then goes down, euro dollar goes up. Okay, and that's because again we have a relationship of euro against the US dollar. If for example we change this, and let's say I want to change the euro dollar and I'm gonna put US dollar Japanese yen, now you can see that these are now highly correlated positively. And why is that? Well, because now we have dollar index against the US dollar and the yen. So now we have the dollar as the main coin, or the main pair again in this currency relationship. So that means that the dollar is going to move the same as the DXY. So when the dollar index goes up, then this is going to go up, because that means that the dollar is strong and the yen by comparison is going to be weak against it. Same thing here. You can see they both move in inverse relationship. Okay? If we go same thing here, let's say we're going to look at continuing with Forex. Let's say we're going to look at Euro US dollar against the US dollar and the Swiss franc. You can see these markets are also inversely correlated, because in this case, the dollar is the secondary market compared in this currency pair, whereas here it is the main market. So that means if euro is looking strong, dollar is going to look weak. So then in turn here, if the dollar itself is now the main coin, then the dollar is going to look weak. And then in this case, the Swiss franc is going to look strong. And you can see same thing here. When euro dollar is trending down, the dollar and Swiss franc in general is going to be going inverse. You can see here, for example, we had a period where this was mostly sideways and this was down. So there are times, depending on the fiscal policy, if there's any central bank announcements, interest rate decisions, etc., that these relationships can be interrupted for a certain period. But you can see right here how the relationship here resumed, and then starting in November, the euro dollar has been on an uptrend and the dollar Swiss franc has been in a downtrend. Okay, now going to other more traditional markets. As we can see here, we have a comparison of gold on top against the dollar index, DXY. So the gold market and dollar usually trade in an inverse relationship. This has been the case for many years. Generally, during times of U.S. economic prosperity and when there's lower inflation, dollar is going to benefit as money flows into the U.S. paper assets such as stocks or bonds, while physical gold is usually less attractive. And this is what's called a risk-on environment. When there's a risk-on environment, that means that people are going into stocks. Conversely, during times of weaker U.S. economic growth and when inflation is higher, or there's, like right now with the whole threat of war and everything, then when there's political uncertainty, traders and investors tend to get out of paper assets and go into what we call hard assets, such as gold. So inflation in general is bullish for the gold market. Now, as we know, that is, the relationship is not always perfect. We know that we've been having big inflationary environments recently in the last 2 years. And you can see, for example, gold did go through a period of downtrend here from March to October of 2022. But as you can see, for example, right here, it did, we did have the inverse relationship. So gold was moving down, dollar was moving up. Then gold found the bottom and been trending up, and the dollar has been trending down. Okay, so in general, gold and US dollar is going to trade in an inverse relationship. Then if we compare the dollar index with US Treasury bonds, such as we have here the 10-year, right here, the 10-year notes against the DXY, well, in this case, usually a stronger dollar means a stronger bond market because of good demand for US dollars in order to buy US Treasury bonds. Okay. In the past, the dollar has also benefited from the fight to quality asset moves. However, since recent international happenings, etc., there hasn't been that much of a pronounced effect when it comes to the safe haven status of the greenback. But like we said, in general, a stronger dollar also means a stronger bond. And you can see here how, the last couple of years, the dollar had a very big rally and the bonds were going in as well. And they both found a top right around November of last year. And now, they've been pretty similar. They both went down and now it's mostly in a sideways movement now. And then just to finish, if we compare US equities such as the S&P 500 with the Treasury bonds, in this case we have the 10-year note in the bottom. So 10-year note against the SP 500. In general, the stock price, stock futures and the bonds markets trade in an inverse relationship. So when stocks goes up, bonds usually go down. However, we did have a period, for example, like I said, these relationships are not always perfect. And you can see right here, when we had the pandemic, for example, both markets crashed. And then pretty much from this period, from March 2020 up until March of 2021, during this whole year, both markets traded in correlation to the upside. And it wasn't around March. The S&P kept going up until the all-time high that we had at the end of 2021. Bonds spend the period mostly sideways. And then right here, once we had the top in the S&P starting 2022, we had a bear market all through 2022 in equities, whereas the bonds had a nice rally there during that period. So in general, the stock indices, equities are going to be bullish and the bonds are going to be negative. And again, you can just compare market correlations, and this is going to help you make more informed decisions if you're looking whether to swing trade or even for a long-term investment in your retirement accounts, etc. It's important to keep an eye out on the relationship of different markets, and this chart comparison that we have here on TradingView or any other platform that offers this is a useful thing for you to track, as well as just to help you to not get overexposed again on highly positively correlated markets. Okay, that's it for the video. Hope you had a great week, and I'll see you all in the next one. Take care.